All right. So as I mentioned to you, like now that it's now this is our first step in our accounting system. All right. Now we are putting those transactions in general journal. All right. Previously, as I mentioned to you, like it was all the receipts, invoices, and everything. Now we are putting those in general journal. Let's say, I mean, we have if a person started business in let's say Mr. John started his business with $50,000. All right. So I'm just giving you the transactions right now. All right. If the John started his business with $50,000, all right. So how would you basically put this transaction in general journal? All right. So this is what we are going to do. Let's say I'm just giving an example. Let's say January 1st of 2020. This is he's putting this transaction in general journal. So this is what we are going to do. We are putting like the year over here, 2020. All right. Always put like a month over here, January, and I'll put like January 1st. All right. So which account is going to be debit? First of all, this is what we are going to do. We are putting cash in the business, right? So we are putting cash is going to be debit. And how we will do that, guys? This is how it's very simple. First of all, cash is basically an asset account. Cash is an asset account, and John's capital, because it is since he's starting his business, so it is the capital, guys. All right, so this is what I was trying to tell you, like how we will put this transaction in general journal. All right, I created this general journal for you. All right, the first column always for dates, right, when the transaction occurred. Within this date, right, the first column over here, it's always for month, guys, always for month and year. And the second column is for the date, guys. The particular, let's say January 1st, 2nd, 3rd, you'll put that over there, guys. Then after that, in the descriptions, you'll put those accounts that will be affected with these transactions. All right. And then after that, for the post references, guys, you will put the account numbers that we discussed that in my previous lecture. Remember, like that we were talking about like 101 for cash, or 301 for capital, those kind of stuff. This is what we are going to put over here, the account numbers. All right. And the amount, whichever account will be debited, that we are going to put that over there, right? The amount over here for the debit account, we will put over here, and the credit amount will. This is how we are going to discuss. This is how we are going to do that over here. All right. So I'm just giving you the first example, very simple example, very basic example. All right. A lot of you probably know about it, right? So what will happen? Let's say, I mean, John, a normal person, he started his business. He invested basically $50,000 in a business. All right. So how would you would reflect this transaction over here in general journal? How would you do that? This is what we are going to do. First of all, two accounts will be affected. All right, two accounts will be affected. This is what we need to understand. There are some keywords that you need to realize when the transaction occurred. All right, so since I put that over here, very simple. John invested $50,000 over here. Invested $50,000. So cash will be affected. All right, that's one account that will be affected. And the second account that will be affected over here is capital, guys. All right. When I used to teach accounting, I always say that like you need to pick up some keywords over here, right? So, but the things that in this case, since invested is kind of sort of like a keyword for you, that will help you to understand that, okay, this is, I'm talking about capital over here. All right. So we have it. So basically he invested cash. All right. He invested cash, $50,000, and invested, two accounts will be affected. The first one is cash, and the second account that will be affected will be capital, guys. All right. Okay. When you do cash and a capital, then cash, as I mentioned to you, like cash comes under assets, guys. It's an asset category. And then we have over here a capital over here. Capital is an owner's equity account. All right. And remember one thing, that owner's equity accounts, they always start with number 3. And assets account, they start with number 1. All right. So right now, the asset is increasing because you are putting money in the business. All right. The business money is increasing right now. when the asset increases, all right, what will happen over here? I'm not talking about the person who is investing in the business. Obviously, he's spending that money, but the thing is that the business the business money is increasing right now. All right. So when the business investment is increasing over here, so the asset is increased. All right. When the asset increase, it's going to be debit. I put that with DR, and the owner's equity, which is capital, is the owner's equity account. And when your owner's equity increase, you'll put on the credit side. All right. So we have already decided which account will be affected. All right. Under what category, under which accounting element you will put that over here. We have already decided, right? Whether it is increasing or decreasing, both of them are increasing, and it's going to be debit and credit, right? Now we need to figure that out, how we will put that in our general journal. Again, I'm telling you, the process is called generalizing, guys. The process that we have over here is generalizing. All right, and we are putting this transaction in general journal. All right, so this account, always remember one thing, guys. Always remember one thing, that when you start general journal, always put debit account first. Always put debit account first. All right, so which account is debited over here? I abbreviated that. It is abbreviated with DR, which is debit. So cash account is debited. So I'll put cash over here. A little bit on the left ended, cash. All right. I'll put a post reference. Under post reference, I'll put like account number. I will put 101. And what was the debit amount? The debit amount was, guys, $50,000. So I'll put $50,000 over here. All right. Then after that, we have which account was credited? Owner's equity. Under owner's equity, we have capital over here. So I'll put John's capital over here, guys. John's capital, a little bit right ended. John's capital. All right, and you'll put on the credit side $50,000, guys. This is how you'll put over here. This is how you'll put the first transaction. All right. Okay, so John's invested $50,000 in cash. So cash we have over here is an asset. It is on the debit side. Even without looking over here, you can easily tell that which account is going to be debit and which account is going to be credit. All right, very simple. Why is that? Because cash is already on is left-handed, and John's capital is right-handed, and you can see that over here, right? And I forgot that over here, like the account number for John's capital, since it is owner's equity account. Let's say I'll put that over here 301, and you already know that all these equity account, they start with number 3. All right, let's start with number. Let's start with another transaction. I forgot to tell you one more thing, guys. You can also put that over here, guys. All right, description in the next line. A lot of time, like, people have different description. I always I prefer that. Okay, John investments. John invested. You don't have to put account number over here. Just put John investment. All right, excuse my writing, but this is how you'll put the description for every transaction. All right, let's discuss another transaction which occurred on January 5th. Which occurred on January 5th. All right, so basically what happened over here, you bought furniture. Furniture was purchased or was bought for $10,000. All right, for cash for $10,000. I'm just giving an example over here. All right, furniture was bought for $10,000, right? So in this case, what will happen, guys? Now, as again, I'm telling you, the same thing will be applied. First, we need to decide which account is going to be debit and which account is going to be credit. That's all, right? Then if we decided, we are sure about it. And I'm telling you right now that the thing is that you have to go systematically. A lot of time people get confused about it. whether it's going to be debit or credit, debit or credit, debit or credit, those kind of stuff. But what I'm trying to tell you, you go systematically. If you go systematically, I'm pretty sure you will not make a mistake over here. I'm pretty sure about it. But you make sure that you go systematically. Okay, furniture was bought for $10,000. I'm just giving an example. Let's say, okay, so what will happen? You paid cash and furniture, right? These are two transactions that you have, and what will happen in this case? Okay, first of all, you'll say, okay, furniture was bought. So this account, furniture and cash. These accounts will be affected, right? Furniture and cash. I'm just giving an example. And what will happen over here in this case? Like we have, like furniture is an asset, all right? Furniture is an asset, and cash, obviously, you already know that, is an asset too, right? Okay. So in this case, this is what I was trying to tell you. Okay. You did not have furniture previously, right? You did not have furniture previously. Now the furniture is increasing in your business, right? So you did not have furniture previously. Now you have furniture. So it is increasing. It is increasing right now. All right. Now, what happened on the other? How did you get this furniture? You got furniture by spending that money. You lost that money this time, all right? And you took out money from the business, right? So what will happen in this case? So when you spend that money, basically you lost that money. You spend that money. Obviously, when you lose that money, you put that over here, negative sign over here. All right. I did mention to you, again, I'm telling you right now that you have to go systematically. If you go systematically, you will not make a mistake. I'm telling you right now. The chances of making a mistake are a little bit minimal, right? Furniture is an asset. Cash is an asset, right? Furniture is increasing right now. Okay, when asset increase, you put on the debit side, guys. All right? And then after that, since you're spending that money, you lose that money, and then what will happen over here? You spend that money out of your pocket or out of the business money, so this is going to be credit, right? Again, I'm telling you, this transaction occurred on January 5th, so you'll put over here January 5th. January, you've already put that over here at the top. All right, now you put those numbers over here. January 5th. Which account is going to be debit, guys? Furniture, right? So furniture is going to be debit. So you'll put furniture on the debit side. And I did mention to you that you always put debit account first. Furniture. Start with, let's say, I'm just giving an example. Let's say 105 for $10,000. All right. And then you'll put cash over here for how much? What's the account number for cash? 101. And you put that over here. All right. So this is what happened. Again, I'm telling you, very simple. Since furniture was debit, so you put the date over here, January 5th. Furniture, the account number 105, $10,000. Cash is going to be credit. You put 101 and $10,000 over here. And again, I'm telling you, if you want to put description over here, you can put description, guys, just without any number, right? Bought furniture for cash. You can put that over there. That's fine. You will not be accountable for that kind of description. All right. Okay, let's talk about another transaction that we have over here. Let's say if I'm talking about on January 10th, 2020, right? What will happen? You bought, you made sales on account. I'm just giving an example. Let's say you made sale on account. Made sale on account for made sale account for $5,000. I'm just giving an example. All right, made sale on account for $5,000. All right, very simple. Again, I'm telling you, you'll go systematically. You'll have the same system, right? The thing is that, like, first of all, which account is going to be affected? Here's the thing that you need to understand. First of all, did you receive cash out of this transaction? The answer is no. You did not receive cash. You did make a sale. Excellent, good job, right? But the thing is that in this case, like, you did not receive cash. All right. So the customer came to you. He made a promise. All right, and you said, okay, you're making a sale, but I will pay you later on. All right. Not right now, but I'll pay you later on. So he, based upon his promise, he said, okay, you agreed on that. Okay, I'll receive money from you later on, but at least you're able to make a sale over here, right? So in this case, you need to figure that out, which two accounts should be affected. Again, I'm telling you that you have to pick up those keywords. If you understand those keywords, in that way it will be easier for you to understand which account is going to be affected. All right, first of all, sales account. All right, and the thing is that, like, since you made a sale and you have to receive money, all right, so that sales was made on account. All right, so the two accounts will be affected. Again, I'm telling you, account receivable, I abbreviated with AR, guys, because he's making a promise that he will pay you later on. All right, and then after that we have another account that will be affected is going to be sales, guys. All right, sale account. All right, so the two accounts will be affected: account receivable and sales. Okay, account receivable, guys, the thing is that a lot of time people, sometimes they get confused, people get confused, but always remember one thing, that since you have to receive money, it needs to be converted into cash. It needs to be converted into cash. All right, so this is what okay, in the previous three transactions, what happened over here? I told you, like, this is the account will be affected. This is what's going to go on over here, like a cash and John's capital and everything. All right, now in this transaction, this transaction basically occurred on January 10, 2020. This time what happened over here, you made a sale. All right, you did a great job. You made a sale, but this time what happened over here? Made sale on account. Made sale on account. Did you receive cash on that part when you made a sale? The answer is no. All right, the customer, you made a sale to the customer, and based upon his promise, what the customer said, okay, I'll pay you later on. Not right now, but later on. So in this case, what will happen? You made a sale. You made a sale on account for $5,000. So which two accounts will be affected? Again, I'm telling you, this time you have to receive money, but not right now. Okay, so account receivable, basically these two accounts will be affected. Account receivable and sales. Account receivable and sales. These two accounts will be affected. All right, account receivable, I did mention to you in my previous lecture. Again, I'm telling you right now that account receivable is an asset. Okay, so account receivable basically is an asset. So you'll put that over here. All right. And then after that, sales, as you already know that, and I also mentioned to you in my previous lecture, that any kind of sales for your business is good, right? So basically it is considered as your revenue. It is considered as your revenue, all right? So account receivable is an asset and sales basically is your revenue, okay? Now the next step will be, what will happen in this case? Okay, now, previously, when you made a sale, did your customer owe any money? The answer is no. Your account receivable basically is increasing right now. It is an asset and it is increasing. Why is that? He did not make promise previously. Now he made a promise that he will pay you later on. So your account receivable basically is increasing, and account receivable is an asset. It is increasing right now. Okay, and at the same time your revenue is also increasing. Why is that? Because you made a sale. You did not have a sale previously. Now you have a sale. Your sale increased. All right. So your asset increased, and your revenue is also increasing. So when your asset increases, what will happen over here in this case, guys? It will be debited. And again, I'm telling you, it will be abbreviated with DR, and revenue it will be credit, because it is increasing by CR over here. Okay. So the transaction occurred. All right, you need to decide, you have to go systematically that which account is going to be debit and which it is going to be credit. All right. So now you need to put that over here the same way that we put the previous transactions. So you'll put start with January 10th. So I'll put over here January 10th. All right. January I've already put at the top over here, guys. So you don't need to put January again over here. So January 10 over here. And what will have which account? All this put a debit account first. So right now we have asset under account receivable is debited. So we'll put account receivable debited. AR is going to be debit, and I'll put like, let's say, I mean, since it is an asset, it has to start with number 1. So I'll put, let's say, I'll put that over here for asset account is going to be 103 for account receivable, and the amount is $5,000. All right. Account receivable, you put the account number and $5,000 debited, and what will happen? Sales account is going to be credited, guys. So sales, I'll put sales over here is going to be credit. Okay, and sales, since it is a revenue account, so it has to start with number 4. So let's say I'm just putting over here 401 for sales. Okay. You can easily see that even without looking at this part, that which account is going to be debit or credit, because account receivable is left indented, it is on the debit side, and sales is on the credit side, right? And again, I'm telling you right now, with the description part, you have a little bit leeway on the description part. So you can put any description over here, or you can say that, okay, sales made on account. Sales made on account. All right, so this is how it will work. So you have created general journal, these 3 transactions. I think that has given you some sort of idea, like how these transactions occurred, how you put them in general journal. My main idea is to like how to put these transactions in general journal, right? The next lecture I'm going to show to you how to put these transactions in general ledger. All right, the transactions may not be the same, but it basically, excuse me, in the next lecture that will give you an idea like how to transfer these transactions in general ledger. The process will be called postings, and based upon those postings, how you will create your trial balance. All right. Again, I'm telling you the transaction may not be the same, but I just wanted to give you the idea how to create general journal, how to create general ledger, and how to create trial balance. All right. For more information, or if you have any question or concern, feel free to put your questions in my comments, and please don't forget to subscribe to my channel, which is Accounting by Rizwan Syed. Thank you very much and have a wonderful day. Bye.